Well, the melt up in stocks keeps rolling on as President Trump's sweeping tariffs take full effect. Big tech and chip makers leading the way, lifting the NASDAQ to new highs, notching its 18th record close this year. This as Trump's pick of Stephen Myron for the Fed board vacancy adds to rate cut momentum. Here to unpack it all is Nuveen Chief Investment Officer Saira Malik. Sarah, has the stock market run up too far too fast, or is what we're seeing justified by the fundamentals?
Well, there's been two main drivers of the rally in stocks, and we did close the week up about 2.5%, so it continues. Those drivers have been the involvement of retail investors and the strength of earnings. So retail investors have been a heavy part of volume. They have been the ones who've been buying on the dip. And then the fundamental story which supports this market is earnings. We came into second quarter earnings season with consensus expectations for about 5% earnings growth. We're going to close second quarter earnings season with low double digits, 10 to 11% earnings growth. So that is the big surprise and the driver of the markets. But we do need to acknowledge that markets are trading at a premium. But if those earnings fundamentals continue, it can support the market going forward.
Yeah, we've seen investors shrug off concerns about tariffs, jobs, inflation, war, more. What's a development to watch for that would signal reason for more caution?
Two areas that we're watching very closely, and that is the impact of tariffs and employment markets. The Fed has stated that they are going to be watching the employment markets very closely in order to determine when they will cut interest rates. We got last month's non-farm payroll data for July, and it was a disappointment at 73,000 payrolls created with downward revisions for the prior months. That's concerning. So we're going to be very closely watching August payrolls to see if they come in weak. If they do, then we could get that 25 to 50 basis point rate cut in September. The other is tariffs. Next week, we will get inflation data on CPI. And so far, we've not seen a big impact of tariffs on inflation, but we'll be watching that balance between goods and services because goods inflation has picked up a little bit while services inflation has continued to be at a moderate level.
On stocks, do you think investors ought to lean into the strength that we're seeing in big tech, or are there other parts of the stock market that you like more here?
Well, big tech has been a big driver of that earnings growth that I talked about, which is coming in almost double the rate of what investors expect. Big tech historically has accounted for almost 70% of earnings growth. It is over 30% of the market cap of the S&P 500. So it is a big driver of the U.S. going forward. Within that, artificial intelligence is a trend that is here to stay. It's alive and well. Companies are investing tens of billions and increasing that investment in AI. So I think big tech and the leadership there continues. But investors should stay diversified. And there's other areas like infrastructure, where we think infrastructure will have multi-year tailwinds, not only from building more data centers in the U.S. to support the AI boom, but also as more manufacturing comes back home and we shift to using more renewable energy, which is going to cause us to upgrade our electrical grid. So that's another area that investors can look at that's somewhat related to the AI boom, but not at the same premium that technology companies trade at.
How about bonds? Are the yields we're seeing now a good deal broadly, and which pockets of the bond market are most attractive?
You need to be selective in fixed income, but there are areas with attractive yields. Two areas that we like, which have strong fundamentals and attractive yields, are municipal bonds and preferred securities. So municipal bonds have strong fundamentals because of the strength of our economy. States have very strong saving rates, high rainy day funds. All of this is positive for necessity-based municipal bonds. And then secondarily, preferred securities are attractive. Behind those are the backing of U.S. banks, who are the biggest issuers of preferred securities. U.S. and European banks have handily beaten their stress tests, so they're in very good fundamental shape. So we like areas of fixed income where not only can you get an attractive yield and income, but the fundamentals behind those securities remain strong.
We've got about 20 seconds. If you talk with someone who's in the home stretch to retirement and they ask you, what do you think returns in the years ahead are going to look like? Will they resemble the ones that we've seen historically? What would you tell that person?
That's probably going to depend on the U.S. exceptionalism trade, which is around technology. If the U.S. tech boom can continue, I think you can continue to see strong returns within the equity markets. But you need to stay diversified, not only equities and fixed income, but start to look at alternatives, which are becoming more available to individual investors: private credit, private equity, real estate, farmland. All of those alternatives, I think, could be interesting, less correlated plays to public equities and fixed income.
Thank you, Saira Malik.